There seemed to be an increase in volatility for oil prices since last week's report. In the current report, we intend to have a look at the state of the US oil market, the role of the dollar in determining oil prices, and the possible implications following OPEC Plus meeting on Sunday. To conclude the report, we will also provide a technical analysis of WTI's daily chart. We start our analysis of the US oil market by having a look at the release of the Baker Hughes oil rig count. The release indicated that the number of active oil rigs in the US has decreased by a figure of 1, which may imply that demand for oil has been decreased. Furthermore, on Wednesday, the API weekly crude oil inventories figure showcased an increase of 4.052 million barrels, which when compared to the expected figure of minus 1.9 million barrels is significant. Moreover, the weekly EIA crude oil inventories figure also came in much higher than expected at 1.233 million barrels versus the expected drawdown of minus 2.1 million barrels. The reversal from a drawdown in inventories last week to an increase in oil inventories may imply that demand for oil from US consumers over the past week has decreased. In conclusion, the apparent decrease in demand for oil from US consumers over the past week may have weighed on oil prices. Another issue we would like to address is the release of the US employment data for May, which is due out on Friday. The US employment data, and in particular the non-farm payrolls figure, act as a gauge for the resilience of the labor market in the US. The current expectation by market participants is for the non-farm payroll figure to come in at 185K, which would be an increase from last month's 175K figure. Therefore, should the figure come in as expected or higher, it could increase pressure on the Fed to maintain their current interest rates level steady, which in turn could maintain the tight financial conditions surrounding the US economy. Therefore, should tight financial conditions remain within the US economy, it could weigh on oil demand and thus may weaken oil prices. In conclusion, should the US non-farm payroll figure come in as expected or higher, it could weigh on oil prices, whereas should the NFP figure come in lower than expected, it could provide support for oil prices. We make a start with our OPEC comment by noting that the group of oil-producing economies met on Sunday. The cartel, as was expected, announced a rollover of the existing productions for the remainder of the year. However, the highlight of the meeting was the announcement that the 2.2 million barrels per day cut will be gradually phased out on a monthly basis until the end of September 2025. Thus, with the announcement that the cartel's voluntary oil production cuts will be slowly phased out, which may lead to oil supply exceeding demand, oil prices moved lower following the announcement. However, we should note that OPEC Plus did also note that the monthly increase of oil barrels into the global market can be paused or reversed subject to market conditions, implying that in the future, should oil prices fall to levels deemed undesirable by the cartel, we may see temporary oil production cuts in order to support the price of oil. However, we should note that OPEC Plus did also note that the monthly increase of oil barrels into the global market can be paused or reversed subject to market conditions, implying that in the future, should oil prices fall to levels deemed undesirable by the cartel, we may see temporary oil production cuts in order to support the price of oil. Nonetheless, we maintain our hypothesis that the future phasing out of the oil production cuts may have been in order to bridge the gap that appeared to have emerged between the UAE, Iraq, Kuwait, and Algeria with the rest of the group. WTICash appears to be moving in a downwards trajectory, with the commodities price having broken below our support now turned to resistance line at the 76.55 level. We switch our sideways bias in favor of a bullish outlook, and supporting our case is the aforementioned breaking below our support now turned to resistance line, in addition the downwards moving trend line which was incepted on the 5th of April. Moreover, the RSI indicator below our chart currently registers a figure below 40, implying a strong bearish market sentiment. We would like to note that the Bollinger Bands appear to have widened, which may imply an increase in volatility and thus may warrant caution for oil traders in the coming week. Nonetheless, for our bearish outlook to continue, we would require a break below the 71.50 support level, with the next possible target for the bears being the 66.95 support line. On the flip side, for a bullish outlook, we would require a clear break above the 76.55 resistance line, with the next possible target for the bulls being the 81.80 resistance level. Lastly, for a sideways bias, we would require the commodity to remain confined between the sideways moving channel defined by the 71.50 support level and the 76.55 resistance line. That's a wrap for today's financial news. Until our next update, from all of us here at Iron FX, we wish you solid trading.